I think I will do like a sharing on my market outlook, and then we will go through the Q&S questions here. So if you guys have any questions, feel free to type into the Slido. Actually, you can scan on the QR code here. I think it will work. So just pull up your camera, scan this QR. You can input your questions if you have any questions. So how many we have here? 1, 2, 3, 4, 5, 6, 7. We have about close to 10 people. I think we'll start right away. Yeah, I prepared some slide actually. Let me pull out. Yeah. Okay. So just hope you can see. You guys can see the slides, right? Can you guys see the slides?
I mean, the screen sharing, right? I mean,
yeah,
now these high-flying tech stocks are bordering on correction territory.
I
don't think it's a slide. It's just a page, right?
Yeah, it's Google Slides. So I will just quickly walk through these slides just to give we stand as of now, 5th of December. Just want to have a outlook and just check on what is the situation right now. So I've put in a couple of slides. Let me quickly go through. So you guys know about this tech stocks has been correcting in the past 1 week, and then so you can see that even for those large companies like FANGs, right, also dropped quite a fair bit. So this is the NYSE FANG Plus. So I think it's like they just track a couple of those FANG names. So you can see they dropped from 8,000 to 7,000, like 7,300. So I think for FANG, it's still not a huge drop, but for other smaller, like those the companies that ARK invest in, I think that dropped even more. So this is a couple of headlines. Then Bitcoin, we know yesterday dropped 20%. I saw this morning recover slightly, but still below 50,000. So let's see in the next couple of days whether it continue to drop or recover. So this is the drop yesterday. But if you look at the trend for, let's say, this year, right, I think it's still, at least it's still trending up. I think it will need to break like this 40,000 support, and then maybe it can get even lower, right? But as of now, I think my fear is that, people always say Bitcoin is very volatile, but looks like the drop, right, is less than Alibaba. Alibaba, all these Chinese tech is even worse, Yeah. So, yeah, just I mentioned about ARK ETF. If you look at their price, I think it's around 52-week low, right? So I think they hurt quite badly because of all this inflation, interest rate hike fear, all these things. So this is something to watch also. You can see the ARKK ETF has been dropping quite substantially in the past 1 week. Then, wow, this is crazy one, DocuSign. When I saw 42% drop, right, my first impression is not like, this is normal. My first impression is that, is there something wrong with the brokerage numbers, How could one company just drop like 42%? It's a bit crazy, but anyway. But if you look at the share price, I think they are still, like, compared to 1 year back, I think it's still positive. So it dropped from a very high point that they reached in a 52-week high. So this is also quite big drop. But I haven't looked into the details, like the reason, is it something wrong or not? Because my understanding is that all these cloud companies, right, they usually traded at a premium. So even if they drop hardly, we can say that it is a value picks, right? But cloud is still the future. So if it drops to a certain level, then I might be interested to take a look as well. So yeah, I will quickly go through all these. I think, like just take a snapshot as of now, look at the valuations of the market. Technical, maybe not so much. Then I will talk about some economic data and also some message that come from Fed. So just a summary. Okay. So I will go to the valuation part first. So, right, when we look at like a single companies, right, usually I don't think like a PE is a good measure if we look at a single company. For example, company A, PE is 20, company B, PE is 30. You cannot just compare these two companies and just conclude that, okay, because the PE is lower, hence the company is cheaper. Because for specific companies, right, the quality of earnings, the business they are in, the growth rate, all these things will play a much greater role in like determining the intrinsic value of the business, right? So they are not so useful if you look at single company. But if you look at the overall market, right, I think the PE or forward PE, I think either one is fine. It's still a good measure to know like whether the current valuation is it high or is it low. So if you look at this chart, this one I pulled up from Yadeni. They have very good charts. I think there are a lot of data and they present it in a chart format, so it's not so boring. I think this is quite decent and useful. So for those who haven't spent so much time to look at all these like for PE, you can later I will share the link to the website that you can take a look. So this is the period after the 2008-2009 crash. As you can see, US, right now the PE, the forward PE is 22.2, but the all country world, right, this is the stock market for the entire world, excluding US, is at 14.5. So for sure, there's quite a sizable difference between the US and also the excluding US, the non-US stock market. And it isn't the case like all the time, you know. So I think if you just look at this chart, you can see that the red line is usually traded above the blue line, because I think US since let's say even 2002, right, they have more like tech names. So these are companies that with higher PE, but there are also periods where their PE is also quite closely with each other. But you can see now the difference is quite stark. Just to let you know, for those who invested in US market, right? If you ask me like, okay, whether S&P 500 is a good investment, is DCA is good, I will still say it is good. But please bear in mind that after the bull run from 2009 until now, right, US market has gone up so much that it's really hard to say US is cheap, you know. So let's say if anything wrong with US economy or interest rate hike, right, bear in mind that it can drop, let's say 20%, 30%, and still it is not that cheap level. So I think this is the message that I want to bring out here. So this is US. Take a look at other economies. I know some are also invested in China market. So let's take a look at China. So I think China, right, if you just look at their PE, is really low. It's at 13 now. But for China, I think you shouldn't pay too much attention to the market, let's say before global financial crisis, because Chinese market, right, the stock market is actually still quite new. Like there are some traded markets in the past, let's say before 2008, but the stock market is still very small, very new at that time, and the data is just not so meaningful. Right? I think it's like after, let's say, in the past 10 years, it get much more mature compared to the past. But as of now, it's still quite young as a stock market. So if you compare their PE, I think right now it's still quite reasonable. I would say actually quite cheap if you compare to other countries. And if you look at the names under this MSCI China, right, these are the names that included those, let's say like Tencent, Alibaba, all those that listed in Hong Kong. So if you look at China A, it is completely different because China A, you don't have that many, all these tech names, right? So it's very different. So when you look at China, please pay attention to which specific index that you are looking at. But as of now, I think you see before the drawdown since late last year, right? Like the Alibaba, all this tech crackdown, they are actually at around 18. Now after the correction is at 13. So yes, for Alibaba, we'll see that their quarterly earnings doesn't look as good. Growth slowing down. The entire Chinese economy also is not like booming, right? Real estate sector, there's some problem, cooling measure, all these things. But for those who enter, I would say this like PE of 13 is really, like you can say, it's quite cheap already. So for those who pay a lot of attention to value, I think Chinese market is still a very attractive market. This one I will just for information, because I know quite a number actually also invested in Singapore. So you can see Singapore forward PE is at 15. But if you look at it compared to historical period, right, they are just about fair. So it's not like Singapore market hasn't gone up that much for since let's say 2008, right? Compared to US market, then they are cheap, right? Not necessary. You have to look at their earnings as well. Because for US, right, if you just look at their price, they actually go up a lot more, but their earnings also growing quite fast. So if you compare the price versus earning 22, I won't say this is like crazy number yet lah. But relative to historical, yes, it is high. But if you look at Singapore, because I think their earnings is not so strong also, so that's why they kind of like stuck there. So their PE is 15. Then the next one is I know some are investing in Malaysia also. I think the picture is quite similar to Singapore lah. So P is at 14. So you go back to this chart, right? You can see that for those outside of US, I think mainly these are like European, Japan, maybe Canada, all this market plus all the emerging market, right? Actually the stock market is not like crazy high. When people referring to like rich valuation, high valuation, I think they are mainly commenting on US. And we all know that US market is really like going up so much in the past few years, right? Because of all this money printing and stuff. So yeah, this is all just some valuation numbers. I think any question until here, or anyone has any comment? Just stop here for a while. Okay, no comment. I'll proceed. I want to keep my sharing short so that we can spend more time on the Q&A. Then I think the questions that many are interested to know, right? In the past, let's say 1 or 2 weeks or so after all this correction, people know that, okay, this correction has something to do with inflation, and then it has something to do with like the fears of interest rate hike. So I think this is definitely something that like it's true, right? Because this is not like just FUD that come from nowhere. It is true that inflation is a bit worrying now. And then it's also true that if we do a projection forward, it is expected that the Fed fund rates, this is the Federal Reserve rate, will increase sooner compared to the past. But I think what I try to bring out here is that something that we should worry on a lot? So that's a question. And one good thing, right? Like I think YCX also mentioned, if you want to understand all these like macroeconomics, all this monetary policy, I think studying too much theory also doesn't help one, because theory is just theory. But I think the best place to look at is just look at history, because if you look at in the past, right, it's not the first time that US Fed increased their Fed fund rate. So the rate line here, right, this line, this is the Fed fund rate. By the way, for those who are not familiar with Fed fund rate, it just means that this is the overnight rate that the banks in US, if they have any outstanding balance, they will have to pay the interest cost, right? So it is equivalent to the shortest maturity instruments and considered as risk-free. So that's the Fed fund rate. And this Fed fund rate will also affect the longer term interest rate, for example, like those 10 years, 20 year, 30 year rates. So there's some relationship between them. And why this Fed fund rate is very important is because this is one of the main policy tool that used by the Central Bank of US to control their inflation. They want to stimulate the economies, or they want to cool down the economies. They are using this Fed fund rate. So the rate one is Fed fund rate. So you see, whenever there's any crash, right? Let's look at like 2008. They will actually drop the Fed fund rate just to stimulate the economies. And before that, this period is also they cool down when they say economy is not doing good. They just drop the Fed fund rate. So if we just go back, right, let's say around after the financial crisis, it stayed low for many years. In fact, from 2009 until 2016. Then after the economics is improving, they think, okay, economy is good, let's raise the rate, right? So they raised the rates from 2016 to around 2019. And then after COVID, they just drop it to zero and just stay there until now. So if you imagine, right, if we're going to have a rate hike, we are expecting to see this kind of like slowly increasing. Then the next question is, during an interest rate hike period, right, will the market just crash right away? Is that the picture that we have seen, right? Actually, it's no, you see. So the area that I highlighted in white here, right, this region, if you look at it, rate hike increase, you see the market also increase on. So this is the period in around 1999 to 2000. Then around just before the global financial crisis also, usually when Fed fund rate increase, the market is still doing okay. Of course, all this there's some fluctuation. This is just normal, right? But we don't see like the market crash right away. So similarly, in 2016, one rate high, and then they fix it for a couple of quarters, and then every quarter they kind of like keep on having rate high, right? You see, market is still going up. Here there's some corrections here, lah. So what I want to show here is that even with monetary tightening, monetary tightening means that there will be some correction in the stock market, but usually it won't happen right away. There will be some lag effect. And if the drop is significant, right, then what the Fed will do is they might just pause the rate high, something like that. So it's very crazy to think that, okay, the Fed is just like coming out just with the intention to crash the market, right? So this is definitely not something that they will do. They will only increase the rate when the economy is doing well and inflation is starting to increase. So if they see that the market is shaky and then economy is not doing well, they might just pause the rate high or even drop the interest rate, right? So I think that's why it's very hard to like make a good macro prediction if you just make decisions based on their actions, because it's very hard to predict what Fed will do. The moment you think that they will do rate hikes, suddenly they drop the rate already, right? So this is something to pay attention to. So I would say maybe don't have to really too worried, especially as of now. I don't expect this crash that we are experiencing, right? I don't expect that we will just go one straight line down. Of course, there will be more volatility, but not to the extent that just like, oh, this is the end. If there's any correction, I think it might happen, let's say, 6 months, 12 months down the road now. Any question thus far at this slide here? No, I will move on. So, okay, if you look at this chart, right, you see the huge drawdown are those like really huge drawdown, like this one from around 1004 to 800. So global financial crisis also from 1004 to even 700 area, right? So these are huge drawdown, but just pay attention to this small drawdown here. Looks very small, right? But actually, if you zoom in, right, this is quite a fair bit of drawdown. So this is the drawdown before the COVID. You see, this is 2018. This is 2019. So this is late 2018. I still remember this is the period where the 10-year rate increased quite high after Fed fund rate keep increasing in this period now. So, and then the 10-year rate is already at a very high level. And then there's this, what they call the yield inversion, meaning the short rate is higher than the 10-year rate. Then we have a correction. 20% is not as correction, right? I still remember this period, even companies like Apple also dropped quite substantially. So for those smaller names, of course, they drop even more. So just pay attention. All this, even with 10-20% drop, right? These are still considered like normal market volatility. Don't be panicked with all this drop. When we say market crash, usually it should be something that is more. For example, like COVID crash, this is definitely much bigger than the correction happened in late 2018. So I would say this 2018 is related to all this rate hike, because rate hike, yield increase, 10-year yield increase, and then market also adjusted, because now if you pull out your money from the stock market and put into like those 10-year rate, right, you essentially lock in like 2 or 3% yield and not like 0%, right? So definitely something that will there's some relationship between the bond market and stock market. So yeah, just for comparison, right? You see, this drop, COVID is around 30%. This drop, 2018, this is nothing. This is just like there isn't like economy, job loss, all these things, right? This is 20%. This is 30%. And the drawdown that we experienced last Friday, I mean, I think this is before the Friday crash, right? Then not crash, Friday drop, right? We are now still at like 5% only. So if this is not the end, it continue to drop another 5 or 10%, I will still say, please relax, because these are just normal market volatility. I think for those who are still new to the market, right, you haven't experienced like really drawdown. You thought that this 5% is a lot, but actually this is not right, because stock market is always that volatile. It's just that with all this money printing, all this money printing, we don't used to market volatility anymore. So even with a 5%, 10% drop, we think it is a big deal, but actually it's not. This is just part of the stock market. So if you are not comfortable with this kind of volatility, then my advice is please keep more cash. So I think at least you will feel much better. Don't stress out yourself too much because of all this. Okay, let me quickly go through like why the inflation, all these things become a much bigger worry. The reason is all because of the inflation data. So, let's say before April this year, right? Like first half of this year, inflation number is still very low. I think this is the period where we already have the vaccine, but still, like we haven't seen too much inflation during this period. Then from April onwards, you can see that it goes above 4%, right? Then it just stay high. And in the beginning, Jerome Powell keep on saying that, okay, this is transitory. We don't expect it will stay there for long. We expect that the interest rate will actually normalize, come back down. But the recent inflation data just shows that, okay, it doesn't like drop from 4.5 to 4 to 3, right? It goes up to 4.6. And when they look at the inflation data in more details, like observing what type of product or services that experience all this increase in price, I think there's some legit concern that inflation is here to stay. So they cannot keep the money printing forever and keep the interest rate at zero forever, because if that continue, right, the inflation keep increasing, it will be even more painful to do cooling measure later, right? Because like even stock market at this level, if they can cool down a bit, is good. If you wait the stock market to go up another 50%, then you need to do something drastic to bring it down, right? It will be even more painful, right? That's why they plan to do a bit more in terms of like cooling down the economy and also the inflation. So, I mean, if you look at this, maybe you can't see the full picture, right? So the next slide that I try to bring out is that you see this core inflation since 2012, right? It always below 2.5%. So we are living in this low, like control or low inflation for quite a long time. And then now we just shoot up to 4.5 and there's no sign that it will come back down, So definitely this is like a legit worry, right? So this is inflation. Then I think this one, I don't recall, I think it's like maybe 2 or 3 days ago, Fed, in one of his speech, he just said that, okay, so I think the word transitory has different meanings to different people. Too many, it carries a sense of a short life. We tended to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean. So it's no longer transitory, So that's why market got a bit panicked. So this is also one reason why like the inflation worry just come back again. So I think these are just words from Jerome Powell, but you can look at the CME or this derivative market just to know like what is the implied probability of the coming rate hike, right? So I think this is the most unbiased numbers, because if you look at all these projection and if you have a different view compared to this, right? For example, you think that the rate hike will be slower or faster than what is implied by the numbers that is showing here, then actually you can bet on the outcome by just trading the derivative, So this is something like market rate already. Usually market rate, I would say quite unbiased, because anyone who disagree, you can actually use your money to vote, So that's why I will pay attention to this. But if you look at this, right, it is true that compared to 1 month ago, And if you focus on this chart that I'm showing here, this is like December 2022. So we are looking at 1 year ahead. What will be the Fed fund rate at that time, the projection? Okay, right now Fed fund rate is at here, 0 to 25 bips. So if you go one step to the right, this is like one rate hike, this is like two rate hike, 3, 4, 5 rate hike, right? So it is expected to have about, let's say, 2 to 3 rate hike 1 year later. So I think the projection is saying that, let's say we have one rate hike in June 2022, and then maybe one more around, let's say, September or December. So this is at least what's the numbers that is projected by the derivative market. And if you look at compared to 1 month ago, right, this probability actually shifted to more rate hike. So you can see here, right, we used to have like 7 and 24% saying that no rate hike to one rate hike. And now this number has dropped to 7 dropped to 3, 24 dropped to about 16. And it shifted more to those higher number of rate hikes, right? But if you look at the average here versus average here, I think the market just priced in like, let's say, from instead of 2 rate hike next year, now become 2.5, meaning between 2 to 3 rate hikes. So I think this is something that is priced into the market already. But you know, like 2 rate hikes, right? If you look back to this chart that I shown earlier, right? You know where is 2 rate hike, right? 2 rate hike means that Fed fund rate will increase from 0, like this 8 basis point to 58 basis point. You can see the chart, right? 58 basis point is probably around, let's say, we are talking about from here to here only. In the past, let's say 2019, the rate hike, that you see how many round of rate hike, actually pushed the Fed fund rate above 2%. And now we are talking about 1 year later, it might go up to 50 basis points. So what I want to bring out here is that if you believe this is a neutral picture, right? Actually, the market will still stay quite accommodative till end of 2022. So for those who are feeling panic, I would say, actually, I don't see like this 5% drop that we experienced, right? And we are not going to end that soon, meaning that these things, it will not like drop like 5-10% that fast. So even if it drop, it might go back up, and then market will just, I won't be surprised, let's say it just come back up. So that's what I try to say. But also bear in mind that when they start to do rate hike, right? You say this kind of rate hike, it's also unlikely that they suddenly press it to 0 if nothing happens. So they will slowly cooling down. And what it means is that you also shouldn't expect the kind of return in last year and this year, just extrapolate forward. This one will not happen, because if this one, the market just become so optimistic and go back to this trajectory, right? What it means that the rate hike will be even more higher. It will cool down the market, right? So I think this trajectory that we experienced in the past 2 years won't continue. So please adjust your expectation. Not every year is 2020. Not every year is 2021. This 2 years is definitely outlier. So if you are uncomfortable, keep more cash. But if you are panicked, I would say also no need to panic so much. Okay, all this from CME website. If you don't know where to look for, just let me know. I will just share in the group. I think this is also a very interesting chart whereby you look at like, let's say just 3 months ago, right? We're still talking about 0 rate hike to 1 rate hike. This is the probability, and now it just strings a lot, right? And those, like, let's say 2 to 3 rate hikes just increase quite significantly. So there's sign that the market believe that this monetary tightening will come soon. Okay, I'll stop here. I've been talking too long already. Let's go to the Q&A. Before we go to Q&A, any comment on the stuff that I'm sharing on all this inflation, all these things? Anything you want to comment? I'll pause a second here just to see anyone have any comment. I hope that I'm still sharing the things, right? If not, become like last 2 weeks, suddenly I disconnected already. I also don't know. Still continue talking. Can I hear some feedback? You guys still here, right?
Yeah, still in.
All right. So okay, we'll go through the Q&A. I think this is not just me talking. Let's go around here. Start from the first one. Thank you guys for your time. Okay, you are welcome. Thanks a lot for those who give comments also. Should I sell my growth stocks? I'll go first. I will say I'll go later lah. I anyone have any comment on this? If no one comment, I will ask YCX to comment now. YCX, you are here, right? No one want to comment. It's okay. Then I will comment. Should I sell my growth stock? I think.
Or maybe I try to comment.
Oh, sure. Go ahead.
Yeah, I mean, when you ask this question, why will you want to sell? I mean, that's the first question. It's not. I mean, because of the market keep dropping or what. So I mean, I will only sell because the fundamental changes or something like that. But it's not because of the market. I mean, the current market situation.
Sorry, your voice a bit too low. Can you speak closer to the mic and louder, please?
Sorry, I was like walking around. So, okay, yeah, can you hear me well? Can you hear me well? Hello.
Yes,
I think there's
now
one
better.
side.
Yeah, I mean, I was saying that yeah, I mean, this question is like, why would you want to sell your growth stock? I mean, what makes you think that you should sell your growth stock right now? And why do you buy in the first place? And what's your buy thesis and what's your exit strategy? I mean, that has to be clear. So, and I mean, I don't think it's a good reason to say that I sell my growth stock because the market keep dropping and yeah. So I mean, that's my thought. So.
Thanks, Edwin, for the comment. Yeah, I do think that that's very true. I think usually when we have this kind of like small correction, small dip, or whether it's larger dip, right? I think it's always this is a good time to actually test your conviction. Because when you bought the stocks, even like myself, right? I bought some, let's say Roku or this Twilio, and usually it is after all this market correction that you will ask yourself whether you are truly have conviction on these stocks. If it dropped 10-20% and you still have high conviction, then I would say then you have found your true convictions. Because usually after market correction, that's the real test, you know. If you don't have conviction now, I will say like just maybe just adjust your portfolio. Is also fine, you know. Like if you cannot sleep because of all this market volatility, maybe don't sell all. Let's say if you just sell 1/3 or 50% of the holdings and that make you sleep better, I think it's okay to do that. But just don't let this kind of event become a waste. Take the time to actually review your strategy, review your thesis, try to understand why you bought it at the first place. Maybe do some journaling, write down your reason. If you continue to hold, why you continue to hold. If you want to sell, why you want to sell now. Just write it down, because your thinking as of now will not be the same. Let's say, imagine that now you sell, right? 3 months later, the market just rebound and make an all-time high again, right? Then you need to answer to yourself. So I would say just write it down, do some journaling, and it will be quite helpful to for you to, let's say, take a reference in the future. Yeah. In terms of the outlook, I have talked about it in my sharing just now, so I won't give any prediction on whether growth stock is good to hold or you should sell, stuff like that. I will pay more attention to how this kind of event will help in terms of your learning, you know. So that is more important. And also pay attention to the names. Like I think as of now, let's say if the companies is loss making, then yeah, just be careful. Not all growth stock are the same, you know. Just name one example, like Tesla. Yes, it has went up a lot, and then there's a lot of there's so many people that are so confident on these stocks, right? It become like a hype stocks, right? But if you look at their earnings, all these things, it's a positive earnings, and not every company is like Tesla, right? So company there are companies that they are loss making, and they still have to count on the stock market to fund the business, to burn the cash, right? So these companies that is burning cash, uh, loss making company, just be more careful because whenever there's drawdown, their drawdown could be a lot more compared to the broad market. Just be careful on that. Okay. Okay. This one move already. Sell because inflation will go against my growth stock. Then this one, yeah, my outlook I already shared. If you are worried that you think that this inflation will come, the rate hike will come, and you think that the growth stock will definitely drop, right? Then feel free to sell it. I think invest in long term doesn't mean that you have to force yourself to hold. It's still okay to do some portfolio adjustment. We just don't want to be like just too reactive to the market situation, right? Because if you are too reactive and then you just sell now and then market rebound, and then you say, oh, I think no more inflation already. Should I chase high? Then I think keep on following to all this market noise, and that one definitely not invest for the long term. So I think this is definitely something to pay attention. Or let's say whoever asking this question, you can actually unmute and maybe voice your view also.
I want to add a bit about selling during this kind of market corrections. I would say you have to think properly whether you need the money or not. Because I would say if you have a job, if because of the US Fed fund rates are going up and inflation is an issue, but if you still have a job and you have income which can sustain your current lifestyle, and your investments are also in companies where they are still growing or at least also making money, I would say you just sit it out. I wouldn't want to see. I would if it's in my opinion, I wouldn't want to say, oh, drop 30% and then everyone is panicking and I sell. But even if you sell, right, you get the money, and then what are you going to do with it? So unless if you have something that's urgent that you need to really pay, let's say you are you have mortgage debt, you can't sustain your current lifestyle, then definitely you have to sell to get some money so that you do not go into bankruptcy or getting into a worse scenario. But if you have your income, your company is still doing well, you are still working, you do not have any big purchases coming up, I would say just hold it out lah. Because otherwise, if you let's say if you have a job, right, and then you see your drawdown is like 30%, 40%, you let's say you were invested at $100,000 and then you are now at 60,000 and then you sell it all off. What are you going to do with the 60,000? Are you going to just put it in bonds or whatever? It just doesn't make sense if your investments are still in the next 4 or 5 years, it will become better. Of course, it's painful to see that, oh, this is like I lost like 2 or 3 years of investing, but that should already be considered when you are investing in stocks. It's part and parcel. It's definitely part and parcel. Like what Bunti just said just now at 2018, when during the 2018 the drawdown as well, my that year's performance was, I think, down like 20%, or in line with the market lah, roughly like that. But and then I think to myself, right, it's like I still have income. I'm not going to do any big purchases. If I sell, right, what am I going to do with it? And then I look at my holdings, and then I have those like Microsoft, Apple, all those things. It just does not go in line with saying that, oh, if the market drops, these kind of companies will definitely do bad. I don't think so. So that's why you need to, when you are picking stocks, right, you really need to see in depth in what kind of stocks you have. And what Bunti said just now was the same thing as well. If it's loss making, if it's not growing, and it's because of the market correction that it will affect its growth, then you can consider. But otherwise, don't worry too much, and don't knee jerk, don't do a knee jerk reaction and just panic sell. And also that being said, you also have to look at your time horizon. If you are like in the retirement age, right, you are 60, 65, and then you are dependent on this asset growing, I would say you're also in the wrong kind of asset class. You should go for like income-based assets. And if you are young, right, 20 something, you should just forget about it and focus on your current work and trying to gain more income. That is just silly to think that oh, I lose 1 or 2 years of investing and then I panic sell, because you are still young, you have like 30, 40 years of compounding. It's just too knee-jerk to do anything.
Yeah, thanks, Kevin, for the comment. Definitely true. Don't panic sell at the worst time. But good to review your conviction. Okay, let's move on to the next one. Wow, this one seven ticks. Quite a number of people that actually bullish on this company. I don't know. That's based on these 7 ticks here. Loss making but good growth like Sea Limited. Anyone have any comment on this? Is value investor here? Not here. Who else? Anyone have invested and have a view? No one.
Maybe,
No one.
maybe I can draw parallels on Sea Limited and Tesla during the 2015 to 2019 time. I mean, if it's loss making, right, you have to see where are they putting their money. Or if you see that they are loss making because they are trying to grow their market share, they are trying to find more sources of revenue, then actually this is the best time to invest. Because if you are sure that they will capture the big market, this is actually the best time to invest. I mean, the same thing like Tesla when they were loss making for, I think, the best part of 10 years after they IPO'd. Because when you see how they are growing, you can roughly project how much that they will be making in the future. And also you have to also look at how are they financing this growth. If they are just keeping piling up on debt, then you have to be careful a bit. But if they can get capital easily, right? You can actually invest more actually, because loss making is the best time to actually invest, because they are cheap, because the market is may not be seeing what you see in the next 5 or 10 years. And if I'm not mistaken, Sea Limited is making money in the Garena area. So they are using the Garena to fund their growth in the e-commerce. So if you think that this is a good plan, why not? You should actually hold it now. You should actually buy more when the price goes down, right? So that's why you need to look in depth into the company. You cannot just say that, oh, the whole group is making a loss and then I should not invest anymore, or I should sell. You have to look into the whole business. Even like Tesla during the 2015, 2009 to 2018 time, they are loss making, but they can get capital quite easily because capital was cheap at the time, and they have the easy they have like a path. They have a vision. So try to look into it first before just saying that, oh, it's loss making and I should sell.
Yeah, thanks, Calvin. Yeah, I think 100% agree on the comment. I just add that yeah, I'm not too worried on Sea Limited, specifically on the loss making part. Like as pointed out by Calvin, their Garena business is still doing quite like still generating profit, and then they just raised some capital not too long ago. So I believe that if you look at their balance sheet, right, given that there's one line of business that is still contributing to profits, and then they raise capital, they have money in their balance sheet to actually fund their expansion, right? So they are not relying on the stock market to get capital raise in the near future. So I would say quite not as worried for Sea Limited. When I say those loss-making company, I think I'm referring to some other companies that's even much worse. Those that really maybe not much revenue and keep burning capital type of companies. So not Sea Limited. Sea Limited, I think it's like they are now transitioning from like overall loss making to actually by certain measure you can see that they are actually already making profits. So this is like in between, not the clear loss making type of companies. Just stop me if you have anything to say. Just to stop me. Then if not, we'll go to the next one. S&P down 5%, but growth stocks are down 30 to 70% from high. What happens is if S&P drop 20%? I think my comment here, right, is just that usually when we see this kind of drop, right, it's just the sequence. What I mean is that now you are seeing all these smaller names, growth stocks that actually drop first because whenever market become a bit panic, some investor that have investing in these high growth stocks, right, they sell first, they move their monies to like safer names. For example, like those Apple, Microsoft, these companies that is like stable, more quality names lah. That's why you see that the drop magnitude is different. Then what happens from now on is that whether this fear will continue, right? Because let's say if the inflation really become out of control, Fed suddenly just say, okay, we will stop printing right away. These kind of things happen, right? Then even for growth, for S&P, it will drop too. It won't stop at 5%, right? It can drop 10, 15%, 20% easily. So that could happen. If that happen, right, I think for growth stocks, it really depends on which one. So you can see here, you also listed down 30 to 70%, right? So definitely some will drop more compared to the others. Then you can see which companies, some are really just more air inside. Some companies there are some substance inside, so the magnitude of drop will be different. I heard there's some voice behind, so if you haven't muted, can you please mute yourself? Thank you. Anyone else have any comment on this? Yeah, okay. All right, so let's move on. Is this a good time to pump more money in or should wait out? Anyone has a comment? Yeah, okay. Standard advice for me is that if you're already putting in money on a monthly basis, please continue to put in. Don't say, okay, now drop 5%, then you just like all in or stop putting money in, right? I would say spend some time to think about what's your investment plan, how much you want to contribute every month, then just do it consistently. Don't change all this like your investment plan just because of a 5% move. Because if a 5% drop, you need to do this kind of change, and then next month it goes up 5%, then you need to change again. Then you will just like busy doing all this market timing, you know. So maybe and that actually have a side effect that will make you more stressed out, because if you see it drop, then you put more money, you actually market timing, you know. So I think that one is actually not so good in terms of like the emotional side. So I would say just DCA constant and regularly. And if you have a list of companies that you already want to buy, then you can just consistently buy. If no, just DCA into S&P 500 or this VWRA ETF, also good. But just invest consistently. We are here to build our wealth, right? Not here to become a market timer. No comment. I will just move here. I'm leveraged on growth stocks and down 33% on my portfolio. Should I reduce risk now with no chance of recovering, or source for funds to endure the loss? Yes, we can hear you, YCX. You want to say something? Now we can't hear you already. Never mind, I will continue here. I think my comment on this is similar to compared to the previous comment. If you are already leveraged, my question is, are you still putting money in every month? For example, I'm now on leverage, but not like high leverage. I think I have like more than 10,000 margin in interactive brokers. So for me is that whenever, let's say every month I still putting in money in. If the if I don't spend that money, right, then my leverage will slowly go down, and then I will actually reduce my leverage, right? So that's actually works for me because I don't have to really stress out because all this leverage will keep on increasing when the market drop, right? So I was just say take some time to think about your strategy lah. First, why you take leverage in the first place, and then will that leverage cause you not able to sleep? Then are you still putting money in? All these things, I without all these like details, right? It's really hard to say. Oh, because you are leveraged now, portfolio down 33%, then you should you should all in or you should sell. No way to give this kind of advice, you know. So really depends on your situation, your own personal financials. But please remember, whenever you are on leverage and market drop, your leverage ratio become higher. And if market continue to drop, then your percentage drop will become even bigger. So that's one definitely something to take note on. If you are leveraged too much, right? Because here also you didn't say how much is your leverage. If you are already 3x leverage here, then I don't know. This one also depends on individual, right? For me, I can't sleep, so I will prioritize my sleep rather than maximize my return. So this is also something that you should consider.
Yeah, hi. Yeah, can you hear me now?
Yes, can hear you.
Yeah, okay. What I actually like to say is that all these questions on like, oh, should I sell now, inflation or whatever things, is kind of like, instead of treating it as like, oh, it's going to be the 1 or 2 year kind of things, the idea of a portfolio is about your allocation kind of thing. It's kind of like you, instead of looking at it as like something that is arcane, just look at it as like your living expenses like that. Like maybe for the next 5 years, what is your living expenses is it going to be like, right? Like for example, are you going to be like, say, oh, my living expenses for food is going to be say 1,000 a month or something like that, or 1,200 a month, and is based on, depending on my income, is going to increase by maybe say 2% per month or 2% per year or something like that, then it becomes very clear. Hey, okay, so every month I'm just going to be allocating this, allocating that, allocating this. So it's like a living, it's like an expenses kind of thing, because ultimately it's about the income that's coming in from your work less the expenses, and then whatever is left over is how you allocate it. And the objective of the investment is so that you, I mean, then you have to determine what exactly is the objective of your investment, right? So maybe if let's say you are young and the objective of your investment is that maybe by 40 plus years old or by 50 plus years old you think that, oh, I don't want to work anymore, then how you put it, how you put your money in there to reach that goal over time. It's not about like, oh, suddenly it's going to go up like 20%, 30%, 50%, that kind of thing. If you're looking for those kind, and you want to have like less, you don't want to lose sleep over it, it's easier to just go to the casino and just play big small or something lah. You straight away, you already know the odds straight away, or it's 50-50 or whatever, or you buy Toto ticket, you straight away know the odds is like that, and if you win you get this amount, is confirmed one. You don't even need to wait long, at most 1 day or 2 days, and you get your results straight away already. It's just that. But if you're putting it into a portfolio that's over time, you want it to grow, right? You think of it as like it's like you are trying to like like you are investing in a kid or something like that. All right, your kid, there are some years that you might think, hey, I need to spend more. Sometimes your kid, like say now have fever, you have to go hospital or something. That kind of thing. Or then suddenly go hospital, you don't say, hey, my kid go hospital, I stop giving money to raise my kid already, right? Because he went hospital. You see that kind of that kind of idea, right? You have that kind of conviction to that kind of things. Then it makes things more clear. What exactly is the end goal? Your end goal could be that you want to see your kid healthy and adulting or something like that, or you want to see your kid get married or something. Once you know your clear goal, then you go on towards it lah. Then it kind of have that mindset in place before you make decisions. And likewise, do you think that if you are leveraged, right, then the idea is that leverage is something about like spending okay, there's these three concepts that are more or less equivalent to each other, which is time is money, and money is also energy, right? So your whole life you only have time, money, and energy, and they are interchangeable. Kind of, you have more of something, you can spend it to get more of something else. And when you leverage, you're trying to get more money by spending future time. That's why you leverage. So if you actually succeed in that bet, then that's good lah. But if you don't succeed in that bet, that means you're taking the future money to put into your current conviction, because your leverage loss is compounded as well. That's the meaning of leverage. There's no way around it. There's no like secret whereby you're able to say leverage 2x while having limited downside. No such thing in the market. Yeah, that's all.
Yeah, thanks a lot. I think definitely true. Just think about the overall strategy and what you want to do. I always encourage that just trade your portfolio as wealth building, putting in your active income, saving into it, and just grow it over time. This is definitely not like a 1 year, 2 year kind of things, right? You need to think long term. So yeah, I think market goes up and down, but your portfolio over time should grow over time, right? That's how we build our wealth. And market drop is always good, right? Because if market just goes up, you can't take advantage on very like those attractive prices. You need all this volatility is always help. Okay, let's move on. Wow, this is 10 ticks. Alibaba has been performing terribly. Should I cut loss? Feels like a never ending falling knife. Anyone else want to comment on this?
Chicken here.
Yeah, your name is showing there, Boon Song. Oh, you're asking whether Chicken is here or not. He's not in.
I'm pretty sure he's the most qualified person to speak about this.
Yeah. So for those who don't have conviction, you can go Chicken's YouTube. I think he's like covering, let's say 80% or 90% of his content are all Alibaba, and then just hear his thought on Alibaba. But my comment, right? I think I released a short video on this. I think it is not. I mean, the current drop is not like something that value keep increasing and then somehow Alibaba share price just go against the market and just dropping, right? If you look at their quarterly earnings, there is some truth that the fundamental has dropped. I think this is definitely. I think no one will argue lah. Their growth is not fantastic. And then there's some concern when it comes to competitions with like Pinduoduo and ByteDance. And then all these like the regulatory change, right? Also make them like lose up some edge when it comes to the competitive edge. So definitely there's some worried in terms of their fundamentals. But also at the same time, I would say that Alibaba is not like, let's compare Alibaba with Intel, right? So Intel is like, okay, already lose out already. They have serious problem. They can't really compete with TSMC, all this. But Alibaba is not, right? Because they are still quite strong in their traditional e-commerce. Still strong. And they still have money to invest in a lot of ventures. And they're still spending money in R&D. They're still spending money in their logistic network to make sure that they are still adding value to the customer, right? So I'm not too worried like their slowdown, all this thing will continue indefinitely and become like IBM or General Electric, this kind of situation. I don't expect that. I think the company is still quite strong. But the worry is like just now I mentioned, the quarterly earnings doesn't look as good, competition. And then the third thing is that their what is it? The overall China economy also there might be the growth also will be slowed down a bit now. I think this might come from, let's say, like the real estate problem or the Evergrande stuff, right? So we will have some impact whenever the government do some cooling measure on real estate, because real estate will drive the entire economy. So all this will have some impact. Their GDP growth might slow down, and Alibaba is so big that their results is already like very tightly related to the overall China GDP, right? So all this backdrop, you can see that yes, there's legit reason why the share price dropped, but it's not to the extent that the company is like going downhill and will die out now. So I don't think that is the case now. So I'm still holding my shares, but I would say I'm not a good person to give too much comment, because my allocations to Alibaba is very, very small. I have a much larger allocation to Tencent and Meituan. So yeah. Anyone else have any comment on Alibaba? I see there's many people interested. Or if you have any other view, you can also just voice up.
I think
the
it's a
market will
bet.
fall tomorrow.
Oh, okay. I think it's a bet on whether you think that Alibaba will get further hampered. I mean, I have no doubt that Baba is going to. They have good people. They have good people, and they have a good working culture that will, over time, it will grow. Definitely it will grow. They will create, they will innovate, and they will gain market share. It's not like there's something wrong with the company. There's nothing wrong with it. The worry right now that is rightly priced in by the market is that every time they do something well, they try to get more. They try to innovate and be good to their shareholders, right? By doing so, right? The worry is that they are good, and then the China government just looks at it and think, hey, this is something that we like, and we are going to take this out from you, even though you built it. That kind of thing, Then if that keeps happening, then obviously, no matter how good you are, the government just taking away the things you create, like the Alipay, these kind of things, like even the WeChat payment stuff. China is trying to like take over things like that. Then it kinds of like is a downer on the entire economy, that whatever you do, if you do it too well, the Chinese government is just going to take it away and co-opt it, nationalize it. Then what is the incentive in further building? Might as well we just keep to our lanes and just do our portions and collect our salaries and think about what to do next, which is either play the meta. Play the meta means whatever China support, I support lah, or I find ways to quickly move my to over time make enough money, move my assets out overseas to someplace else and retire someplace else. That's the kind of mindset that is always in play in Chinese people. That's why you see that they buy properties in like overseas, they buy properties here, there, that kind of things. So so a lot of it is based on how you view the government, right? It wants to do things to it. And Baba, as the largest representative of the entire Chinese market, because if you look at just the entire stocks, Baba is kind of like the face of China in terms of equities. Then you kind of see that a lot of all these fears is when you buy Baba, it's kind of like you're buying like the index of China, like that, more or less, because almost all their index have Baba in it anyway. So you have to factor into account these are the kind of things that you're dealing with, and it's not particularly like the Chinese market is kind of like US style. US style is more of like if the government wants to crack down on something, there is a due process, like you have to go through this, that, and then you have to do all these steps, and the company itself can fight back or argue its case, and then finally there's a decision, and after decision there's still an appeal, that kind of things. In China it's just suddenly you still have all these, but when the government just says I want this, they want that one, you can't stop it. Like that.
Eddie?
I was gonna say that the market will drop a lot tomorrow. That's what I'm anticipating right now. Because I don't know whether you all heard the news. It seems that Evergrande defaulted yesterday. It was reported in Reuters and some other media. Apparently, it seems so. And then late in the evening, PBOC was trying to inject liquidity into the market. Yeah. So anyway, I mean, I expect the equity market tomorrow to drop quite significantly. So I think Alibaba may even drop below $100 tomorrow.
Yeah,
So
I would like to.
It's not the end. I mean, it is not the end yet. It has not reached the bottom yet.
Yes, I would like to echo that as well. I've also gotten the news from Germany that a few of the management funds are initiating a bankruptcy notice towards Evergrande, and they think that this is a very serious issue because Evergrande seems to say something and not and do a different thing, especially towards their offshore debt. So in Germany, there are a few of the retirement funds and some management funds. They always get the news from China that they are going to receive their coupon and their interest and on the debt and so on. But wait, and then they didn't receive anything. So there seems to be some kind of a structural problem as well towards this. So I echo what Eddie is saying as well. So it may have some implications tomorrow or the coming days.
Is this linked to the crypto drop as well?
Most likely it is, because the Bitcoin, you can more or less see the Bitcoin market as like very predictive, one or 2 days ahead of the equities, because Bitcoin is the most liquid market. So whenever there's something, straight away you see people take liquidity out of Bitcoin to other places instantly. Yeah.
Yep. Okay, let's move
can
on.
I add to something?
Yeah,
So,
sure, Edwin, go ahead.
Yeah, I mean, okay, so basically I'm living in China right now. So I mean I have some perspective of, I mean, as a user experience, like using like Chinese apps like Baba and Taobao's JD and Meituan and kind of thing. So I mean, to me, I think as a basic, I mean, as a user wise, right? I think, I mean, in terms of I mean, in terms of, I think Baba is still very competitive. I mean, it's still I mean, it's still a competitive I mean, competition with all these other apps, but it's not like because of the share price keep dropping, that means, I mean, the fundamentals drops a lot. I mean, of course, the recent quarter, I mean, there's some market share being eaten by some other competitors such as Jingdong and Pinduoduo, but I mean, at the end of the day, I think for us, I mean, for me buying stuff in China, right? I mean, it's still up to the price, I mean, whatever price is cheap or more affordable, I would choose that. I mean, like between Ele.me and Meituan, whatever. I mean, same food, but whatever cheaper, then we will get it. So I mean, there's no kind of like uh brand loyalty in terms of what I want, what to go for to make a decision purchasing. So I mean, this is to me is a, I mean, as a user wise, it's a good option for people to choose lah. I mean, with competition, it's good for the people. But I mean, then again, I mean, it's bad. It might impact Baba and some, I mean, other kind of apps lah. Yeah.
Can I just ask a question? You have being in the China, right? What is the sentiment among the Chinese investors? Do you see them trying to buy this deep? Because like obviously we see foreign news, US or slamming the Chinese stocks, right? But how is it in China among Chinese investors? Are they seeing this as a very good opportunity to buy?
I can't really answer that. So I mean, I don't really follow like what Chinese investors are. I mean, the directions are. I mean, in terms of that. So I mean, Chinese, as I think someone mentioned that they like to buy properties, and I mean, like less of actually equities.
Yeah, I can share a bit more. I think for Chinese investors, right? Because if they stay in, let's say Shanghai, right, they want to buy stocks. It's not so easily they can access to like Hong Kong listed stocks or US, so not so straightforward. So for them, I still think that they still invest in let's say using all these investment funds, insurance product, still quite common. And then most of their money goes to real estate anyway. And only those that is very how to say, like really want to invest in Hong Kong stock or US stocks, they need to go to Hong Kong and open an account. So it's not so easy, not so easy. And I believe for them also, mostly, I would say most of them won't think of like invest outside because if they invest internally, right, inside their local market, buying all the A shares, right, there's still plenty of opportunities, right? They are on the ground, so they know which company is good. They can access, right? So there are plenty of opportunities for those A shares. So I don't think majority of them actually interested to invest in Alibaba. Okay, let's go to next one. We cover for let's say 15.
Hi,
Okay.
I would like to add a bit about the Chinese investors. I'm talking from with one of my friends. He's a business owner, quite a large business owner. So among their business owner people, right, they actually don't own a lot of shares. They usually they invest in their own business more than that than owning any other kind of equities. Most of the share investors are always just the retail investors, and they also have a very big gambling mindset in China. So they don't have like some of us who can like look into the company and invest throughout the years. Most of them are very short term. So those rich people, right, usually high net worth, they actually do a lot of foreign exchange, and they usually let the banks do the investments for them. And it's actually quite crazy returns that they can get, because my friend, he has like quite a big sum of capital from his businesses, right? He put just into like a normal cash managed, just like money market funds, and you can get like 7-8% per annum. So for them, they actually don't look into equities. They usually invest back into their own businesses.
Yeah.
Sorry, Kelvin. When you say money market funds, right? Can you specify what kind of funds they are? Because I'm not too familiar with those.
Oh, I'm sorry, I don't know, because my friend, he also not sure one, because it's actually that's the problem with the Chinese financing. It's quite opaque. So he has like, because he's a very high net worth individual, so he has like in 千万 in tens of millions in different banks, and then the banker will just say, hey, I got this opportunity, you can get like 8% or 7%, in 2 years or something like that. Then he will just like, okay, just put it in, just put it in, so even I don't know, I don't think he knows also. So that's the problem also.
Yeah.
The reason I'm asking is because I'm a bit fearful of this Evergrande situation. Given how big their debt is, even if they were to sell off their valuable assets, I don't think they can cover the debt. So there's part of this Evergrande scandal thing is that they have been using repo market to prop up to pay up their debts or something like that. And I'm not too clear about the specific details lah. So one of them that was being talked about is the repo market. I don't know whether I think those people who are trading cryptocurrencies will know better about this. So yeah, so Monday, yeah, likely there will be a lot of volatility.
Okay. Stay safe. All right. We cover for another, let's say 10-15 minutes. Or unless you guys want to stay on, also can. But let's see how many questions we can cover. It's quite a list here. Thought on UPST, I will skip. I'll see anyone who have this view. So whoever is asking these questions, right, you can do a search in the group. Just look for this UPST. I think there's some discussion with value investor talking about this upstart. We discussed before. You can read back some of the past conversation. But as for me, I'm not invested in. So, and I don't have a view. I'll move on, yeah. When do you let go of the falling knife? How do I know that is a falling knife? Let go of ARK because I went in because of the hype and now have no conviction. Falling knife is quite simple. The line goes like parabolic down. You go to, I think you look at Baba also consider falling knife now. Let's say there are a couple of names. I think ARK also considered, right? So, but the pattern of whether it's falling knife or not, I think that's not important. What is important is that this second part here, like, do you still have conviction? Because if after you do like a assessment and you really don't have conviction, I would just say just sell. You don't have to hold the stock because you have some unrealized loss, right? So this one I don't buy it. I think if you already don't have conviction, you just sell is fine. But the question is, what was the learning points from here, right? Because you also mentioned that I went in because of the hype, right? So if you went in because of the hype, for example, the momentum is up, you went in because of hype, then when the hype is ended, right, then you should have already sold, right? You shouldn't wait until it goes until like very down, like falling knife. Then you are like getting in with one mindset and getting out with a different mindset. Like I said, we are here. I think I'm always encouraged invest for the long term, right? You go in with a long term mindset, and then you are unlikely to go out, right, also because you have a long term mindset, right? But for those who are trading, I would just say if you trade and you have some signal to tell you when to get in, then you better follow the same framework to get out now. So you don't want to like get in because of the hype and then suddenly for other reason, then you have to exit, right? Then this one become permanent loss already. So I would say it's fine to sell if you don't have conviction, but please do the assessment and do some self-reflect to think of what happened, like why are you in this position in the first place. Don't let that experience become a waste. And then still I want to repeat what Kelvin just shared, right? Like ARK, they have their methodology. When they look at the companies, they also focus on certain characteristic. Usually they are those like smaller cap, high growth, might be cash burning, might not be profitable. It's not like those companies are all bad companies. It could turn out to be a good investment. But if you only invest with them if you believe in them, right? So if you already believe in them, then why not give them some time, right? Let's say 3 years, 5 years, 8 years to assess the situation. Don't just like panic selling because of a few days of market rate now. Because if you will panic for this kind of market, right, then maybe stock market is just not for you lah. So this is also something that you should consider. Anyone have anything to add on this? Nothing more to add. Let's move on. Are bonds a safe haven? In general, yes, but to go down into more specific, you need to understand what kind of bonds that we are talking about. If it is like a US Treasury, yes, it is safe haven. Even the US dollar is also safe haven, right? So let's say if market becomes shaky, US dollar tend to appreciate. So maybe if let's say you are investing from Singapore, if you hold US Treasury, I would say yes, it is a safe haven. But not all bonds are safe haven because like Evergrande also have issued quite a number of bonds, right? So those are definitely not safe haven. And then there are also those high yield bonds, Asia high yield that Eddie maybe can share a bit more also. Those also not a safe haven because you are taking on credit risk, illiquidity risk, all these different kind of risks that you are taking. But in general, you can look at this, like just look at their past volatility to understand like how volatile is the asset class now. But in general, bonds volatility is lower. And if you are at like you are focusing on the capital preservation, right, then holding some bonds will help in terms of stabilizing your portfolio returns. That's all I want to say on bonds. And like right now we are talking about like all this interest rate hike, right? Please bear in mind that when we say safe, usually what we mean is that for high quality bonds, it is unlikely that they will default, meaning that if you hold a bonds, you will get the coupons, you will get the maturity. But let's say if you invest in bond funds, right, and if the interest rate goes up, right, then the bond value will actually drop, and that will also have some impact to your return as well. So if you care about like the fluctuation or the volatility, then the interest rate movement is also one type of risk that you should be aware of. So don't say that, oh, I say this is safe haven, why the price will drop, right? It can drop. Interest rate goes up, bond price drop. It's just mathematics, So pay attention to that as well. Anyone has anything to add on this? Eddie, you want to comment?
Nothing much to add. I'm still vested in those high yield bonds using those unit trusts. So, but not much lah. It's less than $5,000. So worth when I pump the money in. So yeah, it's just play money lah. But I do get like like between 9 to 10% yields. I mean yields based on my entry price. So but of course the prices have come down a little bit since I bought in. Yeah. So yep.
Yes,
Sounds
you need to see that the underlying is of what quality law, because there are so many different kinds
They're
of
all
bonds.
junk grade. They are all below investment grade. That's why it's called high yield. Okay, so it's like a universe of about 120 different bonds, and pretty much everything is below investment grade. That's why they can generate that kind of yield. But so far, the price hasn't dropped a lot, So yeah, I mean the coupons are still there, but the price dropped maybe 5%, maybe. Ever since I bought in, but yeah, but it's quite the unit trust pricing is quite stable. So yeah.
Yeah, definitely I agree. So I'm just addressing the question, because they say, if you say, you cannot just say everything is a safe haven. There is a risk of default, but definitely the risk is rather low. And also because as a bondholder, you also are a bit higher than the equity holder, if in case of bankruptcy or anything. So yeah, definitely less than, if you go, definitely you go junk bonds, all the yields are higher. So that's why I'm saying that to the question, the person who asked this question, is that you need to look at the underlying, because there definitely is a risk, but at what, so there's always a trade-off lah. Nothing is 100% safe, just to get just to put that point across.
Yep. Let's move on. Understand you leverage your margin in IBKR. Is that a good idea? I think this is should be me, right? I would say margin in IBKR is good in the sense of you are getting very low financing costs. For example, I'm using the IBKR US, not the SG one. So my financing cost is about 1.6%. So imagine, right, if I have money in, let's say, Singapore or this CPF, right, in OA, they give me 2.5%. Here, margin only charge me 1.6%, right? I would rather just take on margin in IBKR and to leverage up and keep my cash in the OA account, right? So I think in terms of financing costs, it's definitely great. But when you ask whether it's good idea or not, also pay attention to like when you leverage up, meaning that you are increasing your risk exposure, right? You are taking on a risk on the money that you don't have. So this one, you really need to pay attention on how much is the amount. For example, if you have 100,000, you can margin up another 50,000, right? Then you invest 150K. So that one will be like your volatility, all this thing will be a lot higher compared to if you don't have a leverage, right? So pay attention to how much leverage that you are taking. But if you already plan to leverage, then I would say IBKR offer a very good financing cost. Other brokerage, I think they also have offered the margin, but pay attention to the cost. That's one thing. Second thing is that there's always risk of liquidation if you are not careful. For example, whenever you are on margin, you need to calculate all this maintenance margin, make sure that it actually you're above the maintenance margin. If not, the brokers that actually have the right to liquidate your positions, right? And usually when they liquidate is at the worst time, like when there's a very sharp drop and market just rebound, and you will sell at the bottom, right? So like I think Kelvin also shared a screenshot from the Wall Street bet, right? Someone just have some options and then just get liquidated because they are not careful with the margin. Whenever you are playing margin or options, these kind of things, you really need to spend some time to understand how the maintenance margin work, or to study in details, especially if you are taking a very high leverage. For me, even though I have some margin, but for those who understand margin, you can take a look at my amount, right? I only take like 10,000 margin, and I don't have that many options. I don't have that many, like relative to my portfolio size is like almost nothing. So I would say myself is actually quite safe. So I'll stop here. I think unless you have anyone have any comment. If not, I'll go to the next one.
How to know if we are IBKR US or SG?
This one you can go to the IBKR website. Maybe later I'll send the steps. There's one place that you can check. Later I share with you easier. All right.
Okay.
Then next one, any chance for the Fed to change their mind and stop tapering with the new COVID variant? Answer is yes. If the economy turns south, they will just stop the tapering. They might even do another bazooka QE. They have unlimited powder, like the Congress, they can just sign, and then they can just send out stimulus check. Jerome Powell with his colleagues can just suddenly say, okay, we stop tapering, we do another QE of 10x the size. They can do that, and they will do that if the situation warrant them to do so. That's one thing. Second thing is that if you specifically refer to the COVID variant, I would say probably not, because new COVID variant also not the first time, right? Because you remember initially we have just normal COVID, right? Just the COVID. Then we have the Delta. But Delta, has that Delta caused any big impact to the job market, economy, all these things? The answer is no, right? I think life still goes on as normal. I believe the new Omicron variants will likely be the same as well, unless there's information that tell us not the case now. So I think this one will not shift their policy significantly. Yeah. That's just my view, but bear in mind that these new COVID variants, there's still a lot of unknown to it. We are still waiting for all this result and more evidence on whether how serious it is now. Anyone has any view when it comes to this Omicron? I think also quite interesting to briefly talk about it. Anyone has any comment? All right, no, let's move on. Not a question, but looking forward to YCX sharing on market outlook. Mr. YCX.
Yeah, okay. So basically is I tend to look at history, like financial history. And the financial history now shows that the outlook in terms of what 1 year time, 2 year time, that kind of outlook. Because frankly, to predict more than 1-2 years is impossible. You don't know, something might happen in that 1-2 years. China might attack Taiwan or whatever things. You never know. But in this 1-2 years is about the all eyes are on the Fed, right? And whether the Fed will hike the rate. And the answer is just now kind of addressed by what Bunty shared with the things, which is that the Fed most likely will not rock the boat, because you must understand that the Fed is like the captain driving the entire US economic ship. And it's not like they can suddenly decide to change course without having like massive repercussions in any direction. It's only when like something like the first time COVID hits, then they suddenly like, oh no, we better do something about it. We better turn our ship like hard right or hard left, something like that. But in terms of like when things are stable and predictable, the Fed will not suddenly change it. Even if inflation is high, it's also still not that high. Like 2% to like their current like what 7%, right? Yeah, it's still higher. It's still higher, but it's not something that they cannot deal with or bring back down. They are still in control of that ship. It's not hyperinflation kind of things. Yeah. And generally speaking, the US Fed has, due to the way it has structured its policies, right, it has a tight control of how the economy is moving. The levers that they have are still relevant. Is the worry is obviously over like I mean right now the biggest worry is what if Omicron or whatever new variant later on, right, turns out to be so devastating, like highly transmissible and highly deadly, that kind of things. Then there will be an issue because it might lead to a situation whereby they are unable to crank the lever anymore. They might actually have to go negative, and while that is happening, the economy is still not doing well. There's going to be more inflation and that kind of things. Then that kind of things will kind of like uh uh go together and do anything. But if let's say that situation doesn't happen, then not much will happen to the Fed. The Fed will just go according to its current policy guideline, which is taper and probably around earliest March. It won't even consider earlier than that. Earliest March, and then like latest September, that kind of time range. Is they don't want to rock the boat. That's basically all there is to it. Everything else is just they will consider, but they move very slowly. And then also some might say that is based on the political cycle as well. So there is a lot of pressure from the politics side to kind of like say, okay, midterms are coming up. We don't want a bad midterms, or we don't want like riots or things like that. And if the monetary policy is not favorable, then it can lead to unemployment, and unemployment leads to riots and things. This kind of things is also in play. And one thing that I mean, you all lived through the Singapore flip-flopping on the COVID restrictions, and you all kind of also understand as a business owner, right? The worst thing that can happen is not easier policies or worse policies. The worst thing that can happen is that the government keeps flip-flopping on what it wants to do. So if it suddenly this month is like that, then next month is like that, there's no way anyone can coordinate their supply chain and coordinate their borrowing, their financing costs and things like that. So the sometimes the cost of making a change is higher than the effect that the change will bring about. So that the Fed themselves also knows this. So when they stir the ship, they stir it slowly. They 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 outline their moves very clearly 6 months ahead, that kind of things. And they might bring the timeline maybe 1 or 2 months ahead, or 2 or 3 months back, but it's always in that range. They won't suddenly say overnight we are going to raise the Fed funds rate by 0.25 BPS, or overnight we are going to taper less by 30 billion, that kind of things. It just doesn't happen that way. Yeah. So things are quite stable, and yeah, they will be quite stable unless something else change. And based on the current things about regarding the Evergrande, right, it seems quite contained to me, unless there is some second order or third order effects, and also whether there's any hidden things. And it doesn't look that way to me, because for one, it doesn't seem like the banks are that like into the Evergrande bond markets, bond purchases. And it seems more like there's just some fund managers whom are have allocated some to that area, and they are going to suffer from that, and their funds are not going to perform as well. That's all. That's all I see from that. As to whether the second or third order, that one requires intensive due diligence to actually find out, and it's not. And if it does happen, then you will see that the Fed will step in again. That's basically what it will be, and you will see that the taper kind of thing get pushed down even further, like maybe 6 months more, 1 year more down, and don't even think about rate hikes anymore. Yeah, so even think about rate hikes until 2023. If really the Evergrande has a large contagion effect, that is what most likely will happen. But if let's say Evergrande doesn't have a large contagion effect, then it's just going to be maybe everyone start selling again based on fear, and then sell another 2, 3, 4, 5% or not, and then you will see the rebound in the next weeks to come, and then things go back to the same, and then you see the chart is like exactly the same chart, and then actually that's what the Fed is hoping for, because the Fed actually likes crashes, because if the crash is more controlled crash down, right, then they are less worried that when they raise the rates by a bit that it will crash hard. Yeah, that's the thing that. Okay, that's all.
Thanks a lot for the sharing. All right. Let's say if you guys have any questions that you don't want answer me comment from me, right? And you want comment from Boon Song, Eddie, or anyone else, or Kelvin, right? Please feel free to let me know in the comments, so I don't have to waste time to give my comment. Okay. So yeah, straight go to YCX. We get the best commentary. What is the most trustworthy back-tested hedge against the stock market beside buying put options, of course? I'll go first. Yeah, I don't think buying put option is a good idea. If you want to hedge against the stock market, right, then you just invest less in stock market, just sell out a bit more, just hold cash lah. I think that is the best hedge against the stock market, because when you are holding cash and the stock market drop by 20-30%, right, then cash is the instrument that has the best optionality, right? You can take the cash and buy good asset at a cheaper price. So just keep more cash if you think that the stock market will drop. Don't bother so much on all these option things. First, it is complicated. Second thing is that you will have all this time decay, this kind of things. Third thing is that let's say after you bought some put option, suddenly market just have a mini rebound, then your put option also become like wipe up, right? So don't complicate stuff. If you think market will drop, hold more cash. If you are bullish, then hold less cash. Just play around with your cash and stock market allocation is simple and good enough. Don't bother so much on all this or put option and stuff. Anyone else have any comment? All right. Should I take on margin now so as to take advantage of the dips? My answer is that if you are not already on margin, then maybe don't do it. Or even if you want to do it, you want to try out, right? Just do it on a very, very small scale. Make sure that you understand how margin work. I think just from emotional point of view, right? If you take on margin, like you when you take margin, I believe that you already like run out of cash already. You're already fully invested and you still want to invest more, right? That's why you take on margin. If not, you just deploy your cash, right? If you leverage up, you're borrowing and you invest into the market, right? Usually there's a very strong expectation that the market should rebound, right? Like now, wow, I dropped a lot. I hope that there's a V-shaped recovery. Buy now. Then it should up. Then you're happy, right? Because you take margin. You don't have this money, but you invest anyway, right? So that's the problem, because if it drop, it doesn't rebound. It just continue to drop, right? And you know that you still owe the monies, right? Actually, that create a lot of stress to your mental state. So that's why I say better not. Because if you have your monthly saving, anyway, you will invest, right? Then just wait for the next month. Just wait until you have the cash. just invest consistently, preferably around same amount every month. Try not to time the market so much. Just have a consistent plan. I think that's the best way. Because if you do something that is make yourself too emotional, right, then it might mess up with your judgment, So that's the risk that try not to go into there. Unless you have a very, very strong opinion, then you just think of like how to make use of the margin. That is also fine. But like few things that I mentioned, right, like all these maintenance margin, all these things you definitely need to know. And it can get complicated. So just be very, very careful on that.
Just don't use margin. Just don't use margin. If you want to, if you want to leverage, you want to earn more than you have, right? That means like play with money more than you have. You just buy a call or buy a put lah. I mean you're just either betting up or down only, right? There's no betting sideways. If you want to bet sideways, then that's you can do that as well. But if you're just betting up and down, you either buy a put or you buy a call. That's it. Then you take it as a lottery ticket, and you don't have any margin. I mean margin is kind of like theta loss. That is the same concept. If you go on margin, you are like losing money to the theta loss. Then you might as well just buy a call and make do with the available money that you have, and that's it. Don't ever go on margin. You go on margin, that is how a lot of people, when suddenly there is a massive movement, they lose everything. That is usually the case with margin. Just don't go on margin. Yeah, the margin is there not for you to go on it. The margin is there so that there is some kind of like settlement thing, like the previous example I brought up, whereby you have $10,000, you bought a $5,000 call, and is in the money later on, and you kind of need additional money to actually settle the call so that you can take advantage of the profit, and then the broker will do it automatically for you using your margin, and then after that you straight away sell the proceeds from your call to get back the money. That's what the margin is for. It's not for you to go and loan it long term and that kind of thing and play that kind of thing. So because they can change the margin requirements at any time. You're essentially just lending money from them, and they already say it's not a fixed rate. They can change the requirement, they can change the things anytime, and in the event of any crash or anything, and the broker, they are centralized, they will protect themselves first. Like right now they can say that the margin is like what, 25% or 20%, but let's say there's a 30% crash or 40% crash, they can just raise that 25% amount to 50% amount, and then suddenly you are like, oh shit, the broker will just force liquidate you. You better put up that amount of money in the next 3 days or something, or we'll just liquidate you. They have the right to change that, because you're borrowing money from them, and the contract, when you do it, you never read it, but then they can change it anytime. Yeah, that's about it.
Yeah.
Yes, I also want to echo that as well. I'm coming from experience with one of my friend. He's like super Tesla bull, and he was quite leveraged during 2019, and then after that the crash in March 2020, he actually almost like got liquidated, and I think he lost like just 50% or more out of that his margins. So it's not always fun and laughter doing margins, just not worth it. And then he also told me that he's not going to do that anymore. So it's not worth it, because like what YCX said, is the same thing. I mean, sometimes because of settlement, yes, you do the margin, because let's say you have currency exchange, it takes 1 day to settle, but then you want to straight away, I want to buy this now. So you buy it, and then after you settle, so that you can have the money now without waiting. But don't do it just for saying that, I want to get extra out of my money and everything. It's just not really worth it. Just think properly first before you do this.
Yep, take the advice from Y6. Don't do this. Especially if you are asking this question, don't do this. All right. Yeah, it's quite dangerous. The margin percentage can change anytime. That's true. So careful. Don't do it. Okay. Yeah, I'll come to the end. QE tapering, impending rate high. I think this one we already. What do all this mean for layman investors? Should we continue to buy growth stocks? I think we talked a lot about this, right? I've got nothing more to add. Anyone has anything to add? No, then let's move on. Will the market crash go deeper? Any good indicator aside from index and stock prices? Index is just index. It's just average of the market. Stock prices is just stock prices. So these two are not indicator. Indicator are those, for example, like do you look at the moving average, you look at the RSI, those kind of things, right? So I think this question also I'm not too sure about what it means. But on the first line, right, will the market crash go deeper? Anyone give you any answer, right? Say yes, no. I will just tell you, don't believe lah. No one knows one all these things. If someone tell you like, oh, will market crash go deeper? Yes, it will go deeper. Then that person will already short the market and make tons of money, right? If they say, I think this market will reverse, will recover, then also that guy already long the market and become rich. This type of things, right? Market movement, right? It's all about probability lah. So don't first thing. Don't ask this kind of questions. And even if other people give any view on this type of things, right? Just don't pay too much. Don't give a lot of weight to this. Everyone is just guessing. Like I'm guessing, like this afternoon, maybe I think it will rain later. It's just guess, right? Later it rains or doesn't rain. No one is liable for anything, you know. So treat it as a entertainment talk. It's fine. Like Tokok Sing Song is fine lah. I think market will crash there. This time is fine, fun, but don't take this kind of advice into your portfolio decisions. Yeah. Anyone has anything to add on this? Wow, we can finish this, but we don't have time to go for those questions in the past. My concern is not inflation, but US soon burst out of China. Nelson, not sure if you are still here. Do you want to comment on what do you mean by US soon burst out of China? Because based on what I know, US is not inside China now. Maybe you mean the Evergrande stuff will affect US as well, right? I actually don't have a view as well. Anyone want to comment? All right. If no comment, I'll stop here. Anyone have any closing statement? Anything to share? Want to share about your portfolio? How it's doing in the past week? Also can. We stay on for 5 minutes. If anyone got anything to chat.
I just want to add a very big thank you to Boon for doing all the research and for conducting these sessions, and also special shout out YCX, Boon Song, Eddie, all those for really sharing a lot of information. I learned a lot from this group. Thank you.
Thanks to you as well, Kevin. You also share a lot. So anyone else? If not, and if no more questions, I think we also go past like almost 2 hours already. Next week there won't be any session. We will catch up again, let's say 2 weeks from now. Yeah. All right. If not, I will close the call now. And if the market is volatile next week, just invest safe, yeah, stay safe, and try not to be too emotional. Remember, invest for the long term, not invest for the next week, yeah. All right. Happy to have you all. Thanks a lot. Bye-bye.